there's a reason to do an S Corp, right? The biggest reason to do the S Corp is you're getting rid of that self-employment tax. You're also being able to isolate yourself from the liability, and all my flips and all my wholesales go into these sub LLCs. You could go too far down the rabbit hole for sure on protecting your liability and your anonymity of some sort in your structures for your business. Are you making your money in active income or in passive income? So I've been doing this for a little while. I have a lot of experience in this, and I've definitely paid a lot of money to attorneys and CPAs, but I'm just gonna show you based on my opinion how I've set up my businesses. Take it or leave it, but definitely go hire a professional to help you out with this. Now, before you do anything though, the first question you should be asking yourself when it comes to a real estate business is, why are you setting up any entity structure whatsoever? Is it that you want to have less liability exposure, or is it that you want to have less taxes? Do you want both? Because sometimes it's a mix between one or the other. Additionally, are you making your money in active income or in passive income? Now, what's the difference between the two? Let's say that you're a wholesaler assigning properties for a contract. That's going to be active income. Maybe you flip houses, like I flipped a lot of houses. That is going to be active income. Now, when you pay taxes on active income, you're paid very differently than you are on passive income. So what's passive income? Maybe you're buying properties and keeping them for the long term. This would be your traditional buy and hold. Doesn't matter what kind of asset class it is, whether it's single family, multifamily, commercial. If you're buying it long term and you're getting that long term capital gains, then at the same time, you're going to be paying passive income on the net income that you're receiving on those properties traditionally. These are taxed slightly different for sure, and very important to distinguish the two. So everything that I do in my business, I first have to ask, why do I want to set anything up? So what's the purpose of it? And then additionally, am I receiving my money actively or am I receiving it passively? Because you'll see that I'm going to have a different setup for both of these altogether. So if you're a wholesaler just starting out in this business, you're going to be focused on active income. So I'm going to start with that. And if you flipped a lot of houses, like I have, you're going to be focused on active income. So I'm going to focus on that first for you guys to show you how I've set up my business structure specifically on this side. And then maybe I'll go into a little bit on the passive. Now, a quick side note on CPAs and attorneys. Spoiler alert, I don't have the greatest handwriting, so get over it. So the CPAs and attorneys, when it comes to this, when it comes to doing these things, in my opinion, you absolutely need both, right? But who's the right one? Who's the wrong one? Who's going to say one thing? Who's going to say the other? Here's the funny thing about CPAs and attorneys. This is, you might have heard this before. CPAs say that attorneys can't do math, and attorneys say that CPAs can't read. A lot of times they might give you different advice. So how do you pick the right one? First, are they asking you why? Are they asking you about active, passive income? Very important that you make sure that they're asking you those questions. And then second, do they do anything real estate related whatsoever? Do they have past real estate clients? Do they have experience on their own investing in real estate? I would prefer my CPA and attorney to actually have experience investing in real estate so they know what's actually up with this business. There's a lot of people out there that are great CPAs that have very little experience working with real estate investors. You want to avoid those people like the plague. Now, at the same time, there's also there's actually not a lot of good attorneys out there that understand real estate structure as well. So asking them, have they set up real estate business structures before? Do they understand what you're trying to accomplish between wholesaling and flipping or accumulating properties for passive income? Do they understand what you're trying to structure here? And do these two agree on how to set it up correctly? You could have some attorneys set up the most elaborate corporate structures that you've ever seen that'll completely make you anonymous, but also make your accounting and bookkeeping the most horrendous and difficult situation that you can have. So you could go too far down the rabbit hole for sure on protecting your liability and your anonymity of some sort in your structures for your business. So an attorney might go down far in the rabbit hole, collect a lot of money from you too, setting up entity after entity and structure after structure. And at the end of the day, the CPA cannot follow the books. And more importantly, your bank cannot figure out where you're getting your money. So you can go too far, in my opinion, on setting up anonymity and liability protection. On the other side, your CPA would prefer you just to be maybe potentially a one LLC or one sole proprietor and with one set of books that all your properties fall into, because it's easier for a bookkeeper and a CPA to follow that structure on a financial basis. Now, the downside with that is that it can expose you to more on the attorney side of stuff when it comes to liability. Plus, a good CPA is hopefully going to set up your structure that will give you a balance between liability protection as well as tax reduction as well. So if a CPA doesn't understand why you should have an S Corp and an LLC, or why a C Corp might be a good thing versus an S Corp when it comes to real estate, then they're the wrong CPA for you for sure. Bottom line with all of that, make sure you're interviewing these people. And more importantly, you can get referrals from other real estate investors that have done it right, because if they're still trying to figure it out, that's one thing, that have done it right, so that they can maybe pass you along to other investors, so other attorneys and other CPAs, and help you out along the way. Okay, so next I'm going to transition into how I've set up my entities for active income. So that's going to be my flips, my wholesales, whatever it is that revolves around active income in my real estate business. For you, there's other ways to earn active income, but these are the two biggest ones, flipping and wholesaling, that most people are going to experience. Now, a side note, how you receive your active income is actually pretty important, especially on a tax side for your state. So always look at your state laws as well as your federal laws when it comes to how you should be paying taxes on these things. Good CPA is going to know that stuff, so keep that in mind. So let's say that we have this house here. We have this beautiful home, right? And whether we're wholesaling it or whether we're flipping it, doesn't matter. If I flip it, I'm earning active income. If I'm wholesaling it, I'm earning active income. So I want to be able to figure out, how do I reduce my taxes, or maybe also reduce my liability and exposure on that? So I got this house here, right? Now I could buy it in my personal name, right? So if I do that, if I buy it in my personal name, so I'm going to sit there and have be what's called a sole proprietor, right? Sole prop, right? At the same time, sole proprietor. We'll shorten it. So if I'm a sole proprietor, then I sell this property, and let's say I make $50,000 selling this property, then I'm going to get taxed on that personally on my income bracket based on my income tax, right? So I'm going to get income tax on that for active income. And if you're somebody like me, I don't want to brag, but I make a decent amount of money. My highest level income tax for federal is going to be pretty freaking high, right? And so I want to figure out a way how to reduce that. Now, if I'm just a sole proprietor, then yes, I am going to pay my federal tax, right? My income tax on that. And that's going to be a higher tax bracket just because it is income, right? And not passive income. It's not capital gains or any of that kind of stuff. I haven't figured out a way how to flip a property and have that property qualify for capital gains versus income tax, active income. If you figured out how to do that, let me know. And definitely the answer isn't holding it longer than 12 months. If somebody's telling you that, they're probably wrong. Now, if I bought a rental that I rented with a tenant in it, and that's what I had with my entire intention, and I sold it after 12 months, I would probably qualify for capital gains. But if I bought a property to fix up, and I was fixing it up, never put a tenant in it, and I sold it because my intention from day one was to sell it as a flip, I'm probably paying income tax on that in that scenario. So if I have this in my personal name as a sole proprietor, or what's called a disregarded LLC, which we'll get into a little bit, then I'm going to pay my federal income tax, probably some state income tax, depending on what state I'm in. But I'm also, more importantly, going to pay self-employment tax, self-tax. Let's just call it that. Self-employment tax, right? Now, what is self-employment tax? Basically, that's where your not workers' comp, that's where your Medicare and your Social Security and all that great stuff comes out of at the end of the day from the federal government, is your self-employment tax. If you are a real estate agent, a mortgage broker, or somebody that actually works for themselves, doctor, lawyer, whatever, you're very familiar for the most part probably what self-employment tax is. A lot of times it's it's like around 15.2%, 15.3%. Don't quote me on that. I haven't paid self-employment tax in a while. And you're going to have that come right off the top. So why is that important? So on a tax liability portion of it, if I'm a wholesaler, I wholesale this house, I'm paying self-employment tax as well as federal income tax with whatever my net gains on that property is at the end of the day. But that's essentially what I'm going to do on this, and I'll pay a lot more money. So the question that we want to do is, how do we help eliminate this self-employment tax? And that's what I wanted to figure out, right? And additionally, maybe potentially reduce my federal income tax, right? And also reduce my liability on the $50,000. So how do I get that lower and lower and lower? And also, if I can also protect myself from getting sued, so we're going to look at that as well. So what have I done, right? So jumping straight into it. So I have set up for myself what's called an S Corp. Now, this is a sole proprietor, basically a sole corporation, single member. Now, in an S Corp, right? It's treated as a corporation. So it's not treated as a sole proprietor, it's treated as its own entity. Now, traditionally, what I'll end up doing on here for me personally is I'll create an LLC, limited liability company, and I will have it get taxed. I'll file a piece of paper with the with IRS, those people, and I'll have it be able to be transferred to be taxed as an S Corp. Talk to your attorney and CPA about how to do that. So I set up an S Corp, and then I create little bitty LLCs, baby LLCs, right? So these are LLCs. Now, LLCs are limited liability companies, right? Now, what's cool about an LLC is you can make an LLC into a corporation, like I did with one of my S Corps. You can also keep them as what's called single member. Now, at the same time, that's also called disregarded. Now, as far as the IRS is concerned, they call it disregarded. As far as attorneys, they call it single members, whatever. So if it's a single member LLC or a disregarded entity, basically they're taxed, from my experience, the same as a sole proprietor would be. So there's no benefit on a tax structure to have a disregarded LLC, right? A single member LLC. Because it's just gonna get taxed as a sole prop as it is. But there is benefit on a liability side because it basically puts this house inside an LLC. So if somebody sues me because of this house, they're suing the entity and not myself. And I'm protected if I keep chastity, if I keep also, the corporate veil put together from being my other assets exposed. Basically, if I have another house here, if I have another house here, if I have my personal stuff, my personal home up here, right? Then in that scenario, I'm so far away from somebody getting my personal home because they can only sue this LLC, which that LLC is owned by this S Corp, and that S Corp has nothing to do with my personal home whatsoever because it's my personal name, and blah, 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 and I got levels of protection there. That's why people might create these. Now, why do we do an S Corp up top, or why do I do that? And then why do I have baby LLCs? Well, for the most part, the reason why is because if I have a single member LLC in this house, right, that single member, the only member is the S Corp. So on one side, I get my liability protection by having individual entities at the bottom with houses or wholesaling or whatever, right? But on a tax structure, each one of these aren't taxed at all. They actually get rolled up into my S Corp, and I have one tax return. So the tax return that I file, I don't file 3, 4, 5 different tax returns on this scenario. I only file one tax return for the S Corp because the members of these LLCs is this S Corp, right? And the S Corp has to file a tax return. I'm going to show you why we want to do that. So in that tax return, it's going to be a corporate tax return, and it's going to show on its corporate structure that it has these baby LLCs, and the income from these LLCs roll up to my S Corp that I have here, right? Now, this is important because it's going to help me pretty much eliminate my self-employment tax, right? Which is what I want to do. That's 15% of taxes right there, right? So additionally, it gives me that layer of protection for liability, but more importantly for myself, because I'm really not too worried about getting sued, is I'm also going to get rid of some tax obligation here. Now, once this S Corp files a tax, right, files the corporate tax, I get a corporate tax return, right, and I get what's called a K1 for myself, and that K1 then goes to little old me at the end of the day, right, over here with my 1040 tax return, which is my personal tax return. So all the money that I made here gets taxed to me, right? It gets sent to me at the end of the day on my 1040 in various ways. And there's two ways that I receive income personally from my S Corp over here. One of it is called distributions. And the only catch, which is why an S Corp is not for everybody, is the other way I receive money from the S Corp is I get W-2 income, right? So I'm an employee. So this is important, right? So an S Corp, this is the catch, this is why it's not for everybody, requires the owner of the business to file W-2 income, right, as an employee, or at least one of the members, somebody has to be it. So for me, I have to be an employee of the S Corp, which means I'm going to pay employment tax on money that I make here. But there's a catch, right? So if I go back down over here to this $50,000 example for math purposes, the 15.2% self-employment tax, right? In that example, now I don't have the biggest brain in the world to be able to do that math on point, so I'm just gonna do it on my calculator here. That's $7,600 in self-employment tax that I'd have to pay if I made 50 grand, give or take. Don't quote me on that because that number might be wrong. So we're gonna keep that over here, and we're gonna put $7,600, right? Now, how do I reduce that? Now, if I only made $50,000 in the S Corp, I have to pay myself a salary, right, of some sort. So that's going to variously change between on how much money you're making as an S Corp. So if I'm making $500,000, my salary has to increase. If I'm making $50,000, my salary can decrease, right? It's based on an equation that the IRS has that you're going to have to talk to your CPA about. But I could probably realistically, in my opinion, get away with paying a $10,000 salary to myself out of that. Right, so automatically, right out of the way, I have to pay out of that $10,000, I have to pay taxes on that. So on an employment tax, so let's keep it the same. For math-wise, let's say it's another 15%. So in reality, it's probably gonna be a little bit more than that. So we call 15 to 20%, give or take, as I'm gonna pay in employment tax and so forth on there. So that's gonna be, roughly $2,000, maybe a little bit more, plus or minus, right? Depending on my income tax bracket at the end of the day. Now, if I'm only making $10,000 plus some distributions, then I'll probably be around that 20%-ish, give or take, employment tax for myself, right? So that's $2,000. So right off the bat, if I'm paying 76 on the 50, and instead I'm paying 2,000, I just saved myself, what was that, $5,600, right, in taxes. So that's awesome. There's a reason to do an S Corp, right? Now, and that's the biggest reason to do the S Corp is you're getting rid of that self-employment tax. You're also being able to isolate yourself from the liability, and all my flips and all my wholesales go into these sub LLCs. Now, here's the catch on this, the biggest catch, and why it's absolutely not meant for everybody. Filing a corporate tax structure, right, as far as tax returns for myself, I have to pay CPAs to do this. I also had to pay attorneys to set it up right. And I also need to maintain it correctly with all the bookkeeping from all these sub LLCs. So all the bookkeeping has to make sense. All of this has to be done correctly, and it rolls up to the S Corp, and then this has to make sense. So somebody has to maintain all that stuff. And if that's not you, that has to be somebody else that you're paying. Additionally, on top of that, I have to file tax returns for this as well, and my personal tax return. And the more of these I have, the more tax returns I have to have, which costs a lot of money. I've paid up to $5,000 for tax returns on really complicated stuff, and you could definitely pay a heck of a lot more than that on really, really complicated stuff. So your basic one, you're gonna have to balance between $1,500 to $3,000 for a simple simple S Corp every single year. So if your tax savings that you're making doesn't justify the expenses of paying for CPAs to do all this stuff for you, plus all the bookkeepers to make sure it makes sense, and you're not making enough money to make it make sense, then in my opinion, I would just have a single member LLC for liability protection only and get rid of all this other stuff, right? Now, once somebody's made some money, and once this is how I started out, I only had a single member LLC, right, for my entity, and I did everything through that. And then I made money, got bigger and better, and realized, holy I need to figure this out because I don't understand any of it. Paid money to attorneys, CPAs, figured it out. They set up the S Corp for me. They said I made enough money now, I can do that. And they structured it, created some other entities for me to start spreading out the risk, right? And it all started to make sense to me over time. So I didn't do this from day one. And if I were starting out and I only planned on doing a couple wholesales here and there, right? Because maybe I'm new or maybe one property, I'm probably not going to go crazy on this corporate entity structure. I'll probably just have a basic LLC to keep my life simple and clean and also reduce liability until I make enough and have done enough business to start justifying the supernova here that we've created. Now, on another note, how many of these LLCs do you need? There's some people that are watching this that are saying, my attorney says I need an LLC for every property that I ever do. That's one school of thought. My school of thought on that is I don't want to deal with that, right? So I'm not right or wrong on that, and neither is your attorney. It all depends on going back to what I said earlier. What's your why, right? For me, I'm okay having a few properties in multiple LLCs. I'm okay having a little bit of exposure there because I do a good business and I have insurance and I also don't mess people up or screw them over. And additionally, I just make everything clean, right? The few lawsuits that we've had have all been really simple ones that we've been able to basically win really, really quickly because we keep a clean business and we do what's right 100% of the time. That said, how much you want to have your risk out there and your liability is totally up to you. Okay, so I want to wrap this section up about passive income. So as I said earlier, active and passive, very different ways that you get taxed, how I get taxed. And I was told and advised that to set up my entity structure differently and have a separate set of entities for my passive structure. Now, this is important, right? The reason why I say it's important for myself is that active income, like I showed you, that's taxed differently. That's taxed at a higher income bracket, that's taxed at a different level, and it can get very messy from based on my experience if we have all our passive income and our active income mixed in the same bag of goods, especially in an S Corp situation where I have to pay I have to pay myself as an employee and all that great stuff, and it can get a little complicated and convoluted. Right? That's important that you talk to the CPA in those details. I'm not going to get into those nuances in this video for the sake of time and also my own liability of telling you something potentially wrong. So this is how I've set it up. This is exactly how I have my stuff set up. So we have these houses. Let's say I got 3 homes, right? It's going to be a very similar situation as earlier. I'm going to have these 3 homes in different LLCs, right? So these are going to be baby LLCs, like I like to call them, right? Little sub disregarded baby LLCs, right? And sometimes for me, I like to put a couple more houses into each one, but for my little thing that I like to do, I usually do it geography based, or any of my commercial properties are in their own LLC completely. I do not mix those up because I feel I have more liability in those. My houses, right, that I have, I'll bunch them together based on geography for the most part. But what I always do though, is I take the advice from my attorneys, and they said, hey, have basically a holding LLC. We're just gonna call it holding. Now this is not an S Corp, right? It's not a C Corp, right? It is a literal LLC, right? Now, what's a little different for it, what some recommendations I have is make this some sort of partnership LLC for a lot of reasons for liabilities, and that could be it can be a smaller percentage partnership with somebody, give somebody 1% or whatever, but there's reasons why you might want to consider this to be a partnership LLC versus just a standard LLC. And I'm not going to get into that for this video, but there's some cool strategies there, so you might want to look at it. So in this, I also have my wife, right? I forgot to put her here, right? So we have these entities roll up to a holding LLC that then rolls up to us, right? We don't pay ourselves as employees in here. We don't do anything like that. This doesn't even technically file a tax return unless it's a partnership LLC, because I'm married to my wife. It's not a partnership LLC. This technically does a liability protection going in here, puts it into a nice pretty bank account at the end of the day too, which we do some other fancy things with, and then it rolls up directly to our 1040, right, which is our personal return. So now what's a little different on these ones that we're kind of big on is we're big on doing Wyoming LLCs for ourselves when it comes to this, and then we do state specific based on these, right? So spoiler alert, my properties are a lot of them are in Washington, right? So these would be Washington LLCs because I don't want to file this property as a foreign entity in the state of Washington. There's a lot of stuff going on in this video, guys. Hope you're keeping up. I want it to be state specific, so that way I have this LLC is filed with the state doing what it needs to do, but the member of this LLC is my Wyoming entity, that my holding company that I have. Now, why Wyoming? Google it. There's a lot of good reasons, but a lot of the biggest reason is anonymity, and I'll keep it that simple. If you're just starting out, definitely ask questions to your CPA and attorney on how to do this the right way for you. Maybe you're going to plan on doing 20 plus houses a year, right? And you know without a doubt you're going to be doing that day one. Maybe you think about structuring your LLCs the way I've talked about it. But if you think you're going to ramp that up, you really aren't sure, you're going to do one, maybe you might get lucky, get another one. Maybe it'll take you years to build it up. Maybe then at that point you can do what I did, which was start small and then add on. But don't do what I really did, which was start small, grow a lot, keep going, put off the bookkeeping, put off talking to CPAs and attorneys, put off all that stuff and figuring it out as I go. And then all of a sudden it was so big and so messy that I had to pay a lot of money to fix everything for a couple of years of mistakes, right? That costs a lot. That's a pain in the butt. You learn a lot, right? But it sucks. And unfortunately, that's the common thread that most people that do this business do. They grow, they go bigger than they thought, and then they pay the price later by fixing it, or they never fix it. So do yourself a favor, measure when you think you should start getting to the next level of how you set up your entities, and just be aware of that. Go interview the right ones. And that said, make sure you guys follow me on Instagram at Tarl Yarber. And if you're somebody watching this right now that say, he should have done it this way, he should have done that way, yeah, probably, right? There's tons of ways you can do this, right? I'm just showing you guys how I did it. So Take it or leave it. Hope it helps. See you guys on the next video, and peace out. If you're in this business because you want to just supplement your income for retirement, it is a very different business strategy than living on the money. This is the biggest time portion of it, but if you do it right, it should be the least amount of time for you if you do it right. There's essentially 6 things that I think that everybody needs to systemize and simplify in their business in order to be able to do pretty much this entire business simplicity.